big story overseas in Asia today is China. Its economy grew at an 8.9% pace last quarter. That is the fastest in a year, and it puts pressure on Beijing to start unwinding its economic stimulus. So let's get some perspective now from the region. We're joined by Fred Neumann. He's a senior Asia economist at HSBC in Hong Kong. Thank you for joining us this morning, or this evening in your time. What were you most surprised by and disappointed by in today's data?
Well, I think a big surprise is that the retail sales continue to accelerate in China. And that really means that the consumer is starting to come back in China. Increasingly, growth is driven by the private sector and not just by the fiscal stimulus. And you can also see that in the investment data. For example, private construction is picking up, and that suggests that the private economy is now taking over from the government stimulus.
Now, we're seeing a reaction in the Asian markets to the latest GDP numbers. The cabinet saying it will maintain its economic policy. When should China start withdrawing some of the liquidity?
Well, we actually believe that China will likely withdraw its fiscal stimulus before it withdraws its monetary stimulus. And the reason for that is very straightforward. There are already some price pressures developing in the construction sector because we both the public sector building out infrastructure and also the private sector now building out private residential construction, for example. So you want to take back the fiscal stimulus before you withdraw the monetary stimulus to try to nurse back the private sector to further strength. And so we don't think meaningful tightening will come before early next year.
Early next year, first half or first quarter?
Well, we might first see reserve requirement ratio hikes in China just to take out some of the liquidity out of the banking sector, and then rate hikes really only in the second quarter. But it's important to remember that the fiscal stimulus will be gradually scaled back already in the first quarter, and that is what the Chinese authorities are looking to first to ease some of the inflation pressures that might emerge by then.
And when the government starts doing that, what would likely be the impact on global markets and global economies?
Well, it should actually be read as a sign of strength. It means that the Chinese officials are confident enough that they can actually start withdraw the stimulus. I was struck talking to some global investors that they were still expecting a second stimulus to come through and saw that as a potentially buy sign. We were actually argue that this would suggest that Chinese authorities are not confident the economy is recovering, and that would be a sign of weakness. So we think it would be a sign of strength and really positive for global markets if they start to withdraw the fiscal stimulus.
Now, you mentioned construction earlier. Property developers in Shanghai have more than doubled this year. To what extent is there a property market bubble?
Well, China overall doesn't have a property bubble as such. There's certainly pockets in Shanghai, Beijing, for example, in the top-end residential market where prices are rising. But it's not a broad-based problem as such. And we don't think, in fact, that's also true for other markets in Asia, that we are in a bubble right now. We can see how, on a current trajectory, you would get a bubble in 1 or 2 years. But right now, as of now, I don't think we have a real bubble.
All right, we thank you for your thoughts. I've been speaking with Fred Neumann, economist at HSBC in Hong Kong.